Hello guys, in this video I'm going to talk about the differences between defined risk option strategy and undefined risk option strategy and how we can trade them. So without any further delay, let's get into the video. First, I have backtested defined risk strategy and undefined risk strategy, both of them. So I will tell you guys the rules of the strategy which I backtested one by one. So first, defined risk strategy, entry on end of the first week of the month. So the next month will be the expiry, our trading expiry. Exit will be on the end of first week of the next month, the expiry month, which is the expiry month. Okay, 30 delta strangle, which means CE and PE sold with the 30 delta sold with the 16 delta CE PE bought as a hedge. So it's a strangle with a hedge. If any one of the strike price is breached, booked the profit on the other side and created a straddle with the 30 delta hedge. Okay, I hope you can get this point. This is the rules of the strategy. For this strategy, I used no adjustment, held up to the first week of the next month and open the next trade with the next 4-month expiry. That is third month considering now. Okay, so with this strategy, I backtested. I will show you the backtesting results. Okay, this is the result. So 2021 it yielded only 2030 rupees for a capital of about 1,10,000. So here 2022 14,000 and 2023 is the most profitable year for this strategy, which is 44,800 around, and 24 up to now it doesn't yield any amount. So with all this, considering all this, you can expect 13% average return from this strategy. So 5% extra return if you invest in the safe asset and pledged and use that margin to trade this strategy. So the net return will be 18% before taxes. Okay. So is there a black swan event risk? No, the defined risk will not have a black swan event risk. You might lose only up to 15% considering the worst case. I'm talking about the worst of worst case. So you might lose 15% with this strategy. Okay, now we will talk about the undefined risk. Okay, this entry, exit and the expiry months are all the same as defined risk. Only the hedges will not be brought here. You can see here 30 delta strangle CEP sold with no hedge. If any one of the strike is breached, booked the profit on the other side and created a straddle. Okay, it's a open straddle without a hedge. Okay, adjustment. What I did was, if the straddle break even is breached on upside, I did a future long adjustment. If the straddle break even is breached on downside, I did extension adjustment. These are the adjustment for this strategy, undefined risk. Okay, now I will show you. So you can see this Excel sheet. So the first year it yielded same capital at 1,10,000 or 20,000 it will come. So 47,000. Next year 2022 59,000 and 2023 74,000. So you can see it yielded a pretty good profit. So these are the time I did my adjustment. These time so these in between gaps are I didn't did any adjustment because there is no need for adjustment for at that time. So you can see the backtesting result. So with this you can expect a 35% average return and a 5% extra return if you invested the safe assets and pledged the margin. So the net return will be 40% before taxes. So here, even though you have a much greater return, there is a risk too, which is a black swan event risk. You might lose up to 60% of your capital anytime. So that is the biggest concern about the undefined risk strategy, particularly this one. So by comparing both of them, you know that defined risk will have less return and less risk. On the other hand, undefined risk strategy will have a much greater return and comes with a much greater risk. Okay, now let's see how we can trade from a portfolio perspective. Okay, here if your percentage of capital, if you have deployed 100% of your capital in a defined option selling, your worst case will be 15% and average return will be 18%. If you deployed 100% of your capital in undefined option selling, your worst case will be 16% and average return will be 40%. This is what we have seen in the previous slide. Okay, now if you only deployed 33% of your capital, overall capital, in an undefined option selling, your worst case loss will be 20% of your overall 100% capital, considering 60% overall loss. Okay, and your average return will be 13.33% of your only 33% of your capital. Okay, now if the balance 60%, you would have traded in a stock strategies, and that would yield the return of 13.2%, considering 20% average return per year. Okay, the worst case loss will be 13.2%, considering 20% worst case loss for stock trading. So with a combined net 100% stock plus option, you will have worst case loss of 33.2%, that is one third of your overall capital, and average return of about 26.53%. I'm not saying here you don't do the defined option selling, because on a average return and a worst case loss perspective, defined option selling beats every other strategy below this. But 18% return and the post return will even reduced to 13 or 14%, so it will not be worth our active investments. That is the only problem with the defined option selling. Okay, undefined option selling 100% is not even an option for anyone, because the worst case loss is 16%. It is unbearable. So if you want to trade undefined option selling, you can consider this 33%, that is one third in a undefined option selling and 2/3 in a stock strategies. So with this you can yield a decent return with the worst case of one third of your capital. Now you can see this is a tax effective also. So the both option selling, defined and undefined, will cost about 30% taxes. So that your 30% will be deducted from here and here. Now here your 30% of 13.33 will be deducted here, and here if you have the short term capital gain tax, only 20% of will be deducted from here. So this combined strategy of undefined option selling and stock trading is tax effective also. Now if you are not comfortable with this 33.2% worst case loss, you can also go with a much reduced undefined option selling, that is 25% and 75% for stock trading, which will reduce the worst case loss to a bearable limit, and your average return will also reduce likewise. That's it for this video. I will come up with another interesting video next time. Until then, bye.